You ever make a money decision that felt, I don't know, right in the moment, only to look back later and think, what was I thinking? Yeah, we've all been there. Well, today we're going to pull back the curtain on why that happens. We're talking about behavioral finance, all those hidden psychological tripwires that shape how you handle your money and how the entire market behaves. So here's the big question, right? We're always told that financial markets are supposed to be all about pure logic, cold, hard numbers. But are they really? Or is it something else entirely? What if the market is actually just a giant swirling mess of human emotions, our collective hopes, our fears, our greed? Okay, so look at this. On one side, you've got the rational investor. This is the person from the textbooks, right? Cool, calm, calculating, always looking at the data, thinking long term. But then you look at the other side, the real investor. And let's be honest, this looks a lot more familiar. We get fearful, we get greedy. We see everyone else buying something and we jump on the bandwagon. That hot new trend, can't resist it. And that gap, that huge space between the ideal investor and, well, us, that's exactly what behavioral finance is all about. So why is there such a big gap? Well, to figure that out, we've got to look under the hood, right inside our own brains. It turns out we're basically running on some pretty ancient software, these deep survival instincts that, frankly, can be a total disaster when it comes to modern financial markets. And this is the prime suspect, the amygdala. Think of it as your brain's ancient alarm system. It's the part that's in charge of fight or flight. So when the market starts crashing, your amygdala doesn't see a spreadsheet. Nope. It sees a saber-toothed tiger. It starts screaming, "Danger! Get out! Sell! Now!" And that gut punch of panic it triggers, that's what turns a simple paper loss into a very, very real one. And this isn't just some abstract theory. We've seen this play out in history again and again. Remember the dot-com bubble? The euphoria was off the charts. People were throwing money at anything with a .com in its name. But when that bubble popped, boy, the panic was real. That was the collective amygdala of the market going into full-on meltdown mode. And then, just a few years later, it happened again. 2008, the global financial crisis. The fear just went viral. It started in one little corner of the market and then cascaded across the entire globe. Why? Because millions and millions of individual investors all got that same amygdala-driven signal to sell, all at the exact same time. And fast forward to 2020, a totally different cause, right? A global pandemic. But the market's reaction? It was almost a carbon copy, a sudden, violent crash triggered by that exact same collective fight or flight response. The key takeaway here is that the trigger changes, but the emotional pattern, that keeps repeating. Okay, so fear is one side of the coin, but what about the other side? Greed. That little voice in your head that whispers about getting rich quick. You know the one. That 25 din may pace a double dream. That's a powerful force too. Yeah, there's actually a name for this. It's called lottery-type stock behavior. It's this weird quirk in our brains where we absolutely love a long shot. We're just naturally drawn to these super risky assets that have a teeny tiny chance of a massive payoff. Our brain just gets fixated on that huge jackpot potential, and it conveniently ignores the much, much higher probability that we're just going to lose our money. But here's where the dream clashes with reality. Take a look at this chart. The yellow bars, that's your lottery stock. See how almost all the results are clustered on the left? Those are small but frequent losses. Now look at the blue bars for more stable stock, much more centered. Sure, that jackpot win is way out there on the right, it's technically possible, but the data is screaming at you. The most likely outcome, by far, is that you just bought a losing ticket. All right, so we've looked at our own individual psychology. Now, let's zoom out. What happens when you put millions of these brains together in one giant marketplace? Well, this is where things get really interesting and a little crazy. See, at our core, we're herd animals. We're just wired to follow the crowd. There's this immense pressure to conform. We look around to see what everyone else is doing for social proof. And of course, there's the big one, the fear of missing out, FOMO, that absolute terror of being the only one left on the sidelines while everyone else gets rich. And don't think this is just a retail investor thing. The big institutions, they do it too. And you can actually see this herd panic in the data. This chart here is the India VIX, sometimes called the fear gauge. When things are calm, it stays low. But look at that monster spike in 2020. That isn't just one or two people getting nervous. No, that's the digital footprint of a full-blown stampede. And a spike like that can kick off something called an informational cascade.
It sounds complicated, but it's simple. It's when people just stop thinking for themselves. They just start blindly copying what the person in front of them is doing. And in a crash, that usually means selling. It's basically the financial equivalent of lemmings following each other right off a cliff. Okay, so we've got our own emotional brains, and we've got the madness of the crowd. But there's one more ingredient in this cocktail, and it might be the most powerful of all. A really, really good story.
I bet you've heard this line before. This time it's different. People say those are the four most dangerous words in investing. And why? Because a compelling story about some revolutionary new AI or the metaverse or whatever the next big thing is, it can be so seductive, so captivating that we completely forget to ask the one simple question that actually matters. And that question is, do the numbers back up the story? You know, a great story gets you excited. It paints a picture. But a company's profit and loss statement, that's the reality check. That's what tells you if they're actually a business making money or if they're just an idea burning through cash to keep the hype train going. And this whole phenomenon leads to something called a narrative premium. It's exactly what it sounds like. It's the extra amount you're willing to pay for a stock, not because of its earnings, but because of its fantastic story. Maybe it has a super charismatic CEO, or it's wrapped in all this futuristic hype. People literally start buying the story, not the company. And the price just gets completely disconnected from financial reality. You know that old saying, buy on the rumor, sell on the news? Well, this is the psychology behind it. People get swept up in the narrative, the rumor, and they buy in, pushing the price up. By the time the actual good news is officially announced, it's too late. The story is already priced in, and the party's over. So let's recap. Our brains are hardwired for fear and greed. We follow the herd like it's our job, and we just can't resist a good story. It sounds pretty hopeless, right? Like we're doomed to make bad decisions? But we're not. The secret isn't to try and fight our own psychology. The secret is to build an investing strategy that works with it. And this is where a cool idea called behavioral portfolio theory comes into play. The big idea here is to stop thinking about your money as just one giant pile. Instead, you mentally divide it into different layers or buckets, and each bucket has a very specific psychological job to do. This pyramid shows you exactly how it works. See the bottom layer? That's your safety bucket. This is your foundation, things like cash, property, stuff that's secure. Then, at the very top, you've got your aspiration bucket. This is where you put the riskier stuff, like stocks, or you're really shooting for growth. You're basically creating a wall between what you need to be safe and what you want to grow. And this is the brilliant part. When you set it up like this, you're giving your emotional brain an off switch. So when your aspiration bucket, your stocks, is going crazy, you don't panic. Why? Because you know deep down that your safety bucket is totally secure and untouched. It's like a built-in circuit breaker for financial fear. So at the end of the day, look, you're never going to control the market psychology. You can't stop the herd from stampeding. But what you can do is understand your own psychology. You can learn your own triggers and build a system that protects you from your worst instincts. And that really leaves us with just one final powerful question. You can't change the market, but can you master yourself?